well, thank you everyone. Welcome to the Climate Risk and Insurance panel, a topic which is extremely timely and top of mind, I'm sure, for many in this room. I'll introduce my distinguished set of panelists, and then we can go straight into the questions prepared for today. It's our pleasure to have Kingsley Greenland, Director of Mortgage Risk Analytics at Verisk, Megan Hart, Global Head of Analytics and Collaborations within Climate Risk Advisory at Aon, and Kieran Bhatia, Senior Vice President, Head of Climate and Sustainability for North America at Guy Carpenter. So let's just get started. So I'm going to ask each of you to give me your broad view of how the insurance industry is currently adapting to accelerating climate-related losses. And where do you think industry efforts really need to focus moving forward? So Kingsley, why don't we start with you, and then we can go all the way to the right.
Sure. Okay. My view is that as of today, there is no industry that is further along in understanding the dollar value of climate risk than insurers. They're in the business. They retain the risk. Where I would like to see some growth, and we're exploring that in pockets, is the insurer's ability to adjust their business with a forward-looking view. Because the insurer retains risk 1 year at a time through the annual policy, there's a case to be made that they've had a 1-year view. Yet, going forward, we understand that these risks are likely to change in frequency and severity. That does adjust a little bit based on the peril of interest. But I expect that, particularly over the next 5 years, you'll start to see increased adoption of what we would call climate condition catastrophe models, where the insurers use them not only on the investment side of the house, but on the underwriting side of the house to make better business planning with a longer term view than 1 year at a time.
Excellent. Megan?
I think there's no doubt that you've seen the insurance industry reacting to the higher cat costs over the last few years. As consumers, you're seeing it as increased premiums that you're paying for your insurance costs, higher retentions, lower limits, and worst case scenario, there are people that are getting non-renewed in certain regions. So we're seeing that firsthand. We're seeing it in the headlines. What we're not necessarily seeing is what's happening behind the scenes within the insurance companies. And that's where they're really focusing on trying to better understand the trends that they're having in terms of these losses. So what is driving these increased losses? Climate change is just really a piece of that puzzle. And they really need to understand that to ensure that they're reacting appropriately to make sure that their business plans are resilient long term. Now, what I would say is, this is a cycle. We're not at the edge of the cliff. Insurance has been around in some way, shape, and form for thousands of years. This isn't the end. This is a period of adaptation. We're also seeing, we're already seeing kind of some softening of the market after we saw big changes over a couple of years. And part of that adaptation process is these insurance companies creating a stronger foundation of data and analytics. So what Kingsley just mentioned, more forward-looking views in terms of what that risk looks like, more investment in innovation and collaboration. So, we're seeing better, industry collaborations with academia in order to really have a seat at the table in terms of how is research evolving and how can that be built into their long-term strategy to ensure that resilience.
Yeah, I feel like we're going to be kindred spirits up here. There's a lot of alignment. But I would say, so we do a broker survey every year at Guy Carpenter. We've done it now 5 years on climate-related topics. So the one of the questions is, exactly this. What are markets, what is reinsurance doing about climate change? How are they responding? Our top responses are typically they're reducing exposure to regions, sometimes exiting line of businesses, increasing premiums, things that we've all just talked about, things that maybe we don't hear as much about, but is now becoming especially more present with the National Association of Insurance Commissioners and some of their new initiatives is regulatory response and asking insurers and reinsurers to provide a little bit more transparency of how they're modeling future risk. Also, unfortunately, a leading answer is none. So we do have some people or so I should say some markets suggesting that they're not asking these questions about climate change. So that's numbers, it's pretty flat. It's not going down. So that's over the last 5 years. I think also something that we have seen a lot of is discussing this topic of sophistication around modeling. The companies that are being leading the way are getting more quantitative, getting more sophisticated, and we have great conversations with them about some of the leading analytics that we can bring into their modeling. But looking forward now, I would say that two topics of interest. One is on this topic of analytics and integrating this into planning, integrating into underwriting a climate-adjusted view of risk and not just looking backwards, figuring out what climate change has already happened and conditioning your catalogs accordingly. That's really, really important. But then also not just looking in our industry, a lot of the work that's been done so far is on the mean signal, right? What is the percent change or the increase in a risk per degree Celsius? But we saw with, for example, the LA wildfires last year, the average rainfall or the annual rainfall in LA County last year was above average, right? And it was also the temperature was above average, but that precipitation signal, if you use the mean signal, is not really going to tell you much. Once you start to factor in things like El Nino and La Nina, the Pacific Decadal Oscillation, climate variability, and potentially climate change's impacts on the Santa Ana winds and things like that, not a lot of people are talking about that and understanding the volatility aspects of climate change as well. So I think that's a place where we're going as well, as being more sophisticated with the analytics. And then finally, our CEO on our quarterly call brought this up, John Doyle, resilience, right? He brought up one study by the Chamber of Commerce, $13 invested, $1 invested in resilience is $13 a return. There's another study by NIBS, the 1:6 ratio. There's another study by World Bank, 1:4 ratio. Similar theme in all three, right? More money up front to protect yourself is worth a lot more on the back end, right? So this resilience topic, and I'm sure we'll talk more about it during this panel, is becoming more and more important.
Excellent. So you guys kind of mentioned, data analytics, models, risk management strategies, forward-looking assessments. A lot of times when we talk about climate change, we're focused on the risk side, but I'd like to hear a little bit more about the opportunity side. Insurers may have opportunities for product innovation here to support evolving household and commercial demand for risk management and for their risk management. And of course, on the other hand, as we've talked about, rising and unsustainable losses can threaten insurer profitability and even their solvency. So of course, there's a balance here. So how do you guys think about the sort of balance of risks versus opportunity? And again, this is for all the panelists. So let's start with you, Kieran, and then we'll go the other way this time.
Yeah, I think that there's the obvious one, whereas if there's more demand, you're going to need a safety net, right? So that immediately says, okay, well, there's going to be more insurance needed. But of course, there's this whole flow chart, which is, is it good demand and all the pieces, right? If you have too much value in areas where there's a large amount of vulnerability and the hazard's getting worse, that demand is not necessarily a good thing, right? And it's understanding, okay, well, how do we make those areas still palatable while all those elements are going the wrong direction or becoming, meaning the pricing is going to need to reflect that. So that's a challenge there, because on paper, increasing climate-related risk, increasing hazard, you would think that, oh, okay, there's more need for insurance. But yeah, let's flip it on its head a little bit with the opportunity side of things. Is that with a increasing risk and with the challenge of climate change, there is a chance to incentivize good behavior. There's new industries in the mitigation space that deserve or are going to require insurance, whether that's renewable energies, whether that's carbon capture. That all is going to be new lines of business. And if you're focusing traditionally on what we would say the classic forms of energy or the classic forms of production or manufacturing that maybe aren't as palatable with a changing climate, then you're going to be in trouble. So I think that's really, really important. I think there's a lot of what we've seen with the resilience is that there's a lot of focus traditionally on, the state of California now, because of wildfire, is maybe not as desirable to be in as an insurer. I think that's these broad generalizations about geographies and perils should be extinct. I think it's one of these things where with the new technologies, and I was just at a climate tech event with Kingsley, is that with these new technologies is that you have satellite technology, AI technology, drone technology, where your vulnerability view, your risk view, your exposure view is down to the building level, as it should be. So that information should be weaved into all of the views of risk, and that's new business. That's more, I would say, boutique writing of insurance that's going to allow for better price risk. That's a big opportunity. And I think also what we've seen from the wildfire question as well is the community level, not just at the individual house level, working together as a community and having a way to incentivize positive community behavior, and having whole real estate pockets or neighborhoods that are following a set of guidelines and are now considered desirable. That is going to have feedback on other industries. That's going to benefit the real estate industry. That's going to benefit state and local governments. So all those things working together, those should be viewed as opportunities, not just risks.
Excellent. Megan?
Sure. So I think when we think about risks and opportunities, we can't decouple them. And I'm going to harp on this a little bit, but this idea of the importance of data and analytics really sets the foundation for both identifying and managing risks and also identifying and managing opportunities. So as you're assessing your current portfolio and you're trying to manage maybe loss trends that are not welcome in your business and introducing too much volatility, you can change your strategy there. But as you're doing that, you're identifying opportunities for new product innovation to help fill those gaps that either already exist or that we're creating because we're lacking the capacity or knowledge in order to fill that with our current tools. And so that gets us to the place of what kind of risk are we willing to take on to fill those gaps? If it's not a traditional indemnity type cover, maybe it is a parametric type cover. Maybe it is community-based insurance. There's other mechanisms that we can put in place to kind of fill those gaps in that product innovation. And I'm glad you brought up renewables, because I think when we talk about climate risk, it's not just weather and natural catastrophes, which it still is in a minute, but when we're thinking about the importance of the insurance industry in order to support investment into new technology in order for us to get to a lower carbon economy, insurance is key. And so what we also need to be doing is creating those insurance markets and opening up capacity for things like battery energy and storage systems, small nuclear reactors. There's all these new technologies that are coming into play that are a bit scary to the insurance industry because you don't have that historical claims data in order to leverage. So that brings us to kind of the innovation piece and the need to upskill, within the insurance industries to allow for us to support that innovation and scale these new technologies.
Very interesting. Kingsley?
Sure. I'll be brief. I see two areas of growth in traditional lines of business. One is stepping in to fill the flood protection gap. The NFIP was created way back when flood modeling just wasn't in the place that it is today. So as you continue to see stress in that market and you see gaps, particularly on the mortgage side, between where we're experiencing flood damage and where the catastrophe models know it exists, I think that creates an opportunity to write more premium in the private sector. I've also seen encouraging signs of new business ventures and multi-year insurance policies. So from the perspective of a lender, I have this concern that if I write a 7-year loan and I expect my collateral to be protected over that term, that's how I reduce my risk as the investor to put that capital out. Well, embedded in that is one-year options for the insurer to change the price or the coverage. So there's this embedded demand to say, I am willing to pay some premium to the annual year cost to get multi-year coverage. And the other two, maybe smaller areas inside the insurer, is better integration between the investment side of the house and the underwriting side of the house. So we have expertise in underwriting in managing cat risk that, in my view, in my experience, has not yet made it in front of the CIO. On commercial real estate, large residential investments, it seems like low-hanging fruit. Pause there.
Very good, interesting. So now I'm going to ask individual questions. So why don't we start with you, Megan? You mentioned earlier that climate change is only one component of what's driving rising losses today. So I'd love to get your take on what's driving rising losses and what steps are insurers taking to really encourage maybe policyholders to make investments into risk reduction, mitigation, resiliency, et cetera.
Sure. So that's a challenging question because it's not one answer to all of that. When we think about the increasing losses that we're observing, the drivers are going to be different depending on what peril and what region you're looking at. So that becomes a huge effort to dig through this data and understand those drivers. So, if we think about wildfire, that's one area where we have high scientific confidence that burn areas are getting larger. So they are becoming more severe. But in terms of what's driving the overall losses, quite a bit of that can be attributed to more exposure in the wildfire-prone areas. So those are big areas. In severe convective storm, same thing. So we're seeing these very large SCS losses, and a lot of that is driven by exposure. There's also inflation. There's supply chain issues that are leading to, increased costs to rebuild. So climate is one aspect of it, and we really need to understand where we have high scientific confidence around where the hazard is changing and where we don't. So high would be, extreme rainfall, sea level rise, impacting storm surge, wildfire, where hurricane intensity, but maybe not hurricane frequency. There's different aspects of these events that we need to consider as well. Where we have lower confidence is things like severe convective storm. We think that HAL could get slightly larger as the climate warms, but we really need to match scientific research and modeling with observational data and to get to that final answer. In terms of what insurance companies can do. So I'll mention, a couple of examples. So the Insurance Institute for Business and Home Safety has a program called Fortified, where it tells you if you're going to build a house or retrofit a house, here's what you should do to be deemed, silver, gold, and beyond. So you're going to have hurricane shutters. You're going to have your roof connected to your wall systems with hurricane straps. There's sort of a checklist on this. And the insurance companies know about Fortified. They invested in Fortified. And so they will build that into their mechanisms for determining your premiums. So you will get rate reductions if you are a fortified structure. So that's one example. Another is, we're starting to see mitigation credits for wildfire in California. So we've got a couple of examples. What I would just say is there's huge opportunity to scale that and quickly into other types of resilience credits that the insurers can build into their pricing mechanisms so that, as consumers, we are getting benefit from the initial investments that we're making. We also need to make data more available to the consumers. I know that was a topic earlier today. While, as Skylar said, data be dirty, data also be helpful. And so in terms of, putting that in the hands of the consumer, maybe that the insurance companies, mortgage lenders, making that available so that consumers can make better decisions when they're about to make an investment in their home.
Excellent. All right, so switching gears a little bit, Megan mentioned that the drivers of losses really vary by geography, by peril. I was wondering if you could talk a little bit, Kieran, about the impact of climate change on hazard risks, and in particular, what geographies or particular perils are of particular concern in your models.
Sure, yeah. So at Guy Carpenter, two of the main ways we look at this is through risk scores and CAT model or catastrophe model adjustments. So understanding kind of based on the leading research, based on academic collaborations, internal research, how to either adjust the climate models or produce our own view of risk and bin it across the country and compare, okay, under different scenarios, under different time horizons, what does your exposure look like in present day versus future from these different perils? So now, there's always the topic, and this is as a scientist, you know, by background, everyone wants to talk about, okay, what's the hazard you're the most worried about? What's the event you're the most worried about? There's a lot, unfortunately. That's, you know, it's one of these classic keeps you up at night things. But as someone who, I did my PhD down at University of Miami, and I really got to know that area pretty well. A lot of focus has been on the western part of Florida, but I think a really interesting thing that people don't talk about a lot is that with the, you know, big cities on the eastern side of Florida, between Key Largo up to Miami, Fort Lauderdale, Palm Beach, that area in the last 75 years has only been hit by one major hurricane going from the east, right? So 75 years. And a lot of times in our head, we think of those areas, you know, Miami, Fort Lauderdale, we think, oh, this is a hurricane-prone area. You know, we have areas in Louisiana that have been hit by 5 major hurricanes in the last 20 years. So it's kind of, yeah, you're kind of like, oh, well, then why do we even talk about it? Really interesting is that if you go then back to a decade not so recently, 1945 to 1950, 3 major hurricanes actually hit those between that, you know, Key Largo to Fort Lauderdale area in 5 years, you know, 6 years. So one of these, and this is why, you know, companies like Verisk and others are really important for your CAT models and how they produce the CAT models, is these areas are just based on historical record and based on future projections, quite risky. And from an exposure perspective, from a vulnerability perspective, a lot of the building code upgrades that we've seen on the western part of Florida, some of them have manifested themselves in the new builds in Florida, on the east side of the state. But a lot of those areas have not seen some of those retrofits and new builds. So as a result, that's something that I'm particularly concerned about because, for example, that area is a very risky area from the historical record. From the scientific perspective, there's no reason why major hurricanes cannot hit that area anymore. And then when we have our catastrophe models and we view this climate change risk moving forward, right? A lot of our approaches are resampling events and saying, okay, these events are going to become more likely in the future. Something that we don't think about is also, we do think about, but it's harder to model, is how do we get that out of sample event that has not yet happened before and could potentially impact this very vulnerable area. Florida, that area around there and the ocean around there can foster incredibly strong storms. We've seen it with Irma and Dorian just missing some of the most populated areas. So that's an example of a region that I'm particularly interested in. Hurricane, of course, is our largest loss driver for the industry. So I think this recency bias and having a lot of individuals who have not yet experienced these types of storms and don't know how to prepare yet, and then coupled with the fact that we could have an out-of-sample event that we just haven't seen how strong things can get yet, those are the kind of multi-prong nightmare attack that I get.
Interesting. So maybe we are talking too much about Tampa. We need to be talking about Miami a little bit more.
Talk about both, yeah.
Or talk about both, yeah. Very interesting. So Kingsley, I'm going to turn to you. A lot of what we're hearing is about CAT models, which is, of course, a product that Verisk produces for the insurance industry. CAT models are important, but they're really hard. So I'd love to hear you talk a little bit about the biggest challenges you see with modeling catastrophe risks, particularly related to climate change, and how is Verisk and your team working to fill those gaps?
Yeah. Okay. So catastrophe models are designed to give a damage-centric view of low-frequency, high-severity events. That means we live in a world of data scarcity and uncertainty. The standard framework goes more or less like you'll take a catalog of synthetic events that is influenced by history, but not entirely dependent on it, of years that include natural catastrophes that may happen. So those synthetic events is where a lot of the research and IP is. It's designing certain wind speeds, hurricane pathways, flood depths, flame intensity, you name it. And then hitting different buildings or portfolio of buildings through what we call the vulnerability module. After we determine how much damage these series of events may cause to the building, we create what we would call a damage ratio or a mean damage ratio and say this is what we could expect the gross or ground up damage to the asset to be. And then we offset that with different views of insurance. So through each of those three modules, you introduce modeling uncertainty. The two big pieces are estimates of the probability that the event will happen. We have a pretty good view on the likelihood that something will occur in some place, but it is modeled. The second element is once that event has occurred, how much damage is that going to do to the structure? It's not axiomatic how much some wind speed will damage a certain building. It's an estimate. So that's the case today in the climate that's already changed. That's one area of focus, is saying this 1.3 degrees C, how should it be reflected in our current catalog? Transition that to how we can look forward. Well, then we have to use derivatives from climate models. Those are also an assumption-based discipline that introduces uncertainty. We have multiple pathways. We have multiple scientific views of climate sensitivity, meaning even if we knew exactly how much carbon would be emitted over the next 30 years, which we don't, there's no one climate model that tells you exactly what that will do to a certain grid cell, to global temperature. So assume we had all that right. We still have the challenge at a peril level of saying, is there a physical basis that we can take from a climate model and use it to adjust the catastrophe model forward? For some perils, that's readily available, something like sea surface temperature for hurricane. Makes sense, it's a fairly straight line. Wildfire, we can look at something like antecedent conditions and vapor pressure deficits, another term for aridity, and say, well, this makes sense to adjust it forward. But other perils that are of interest, that isn't necessarily something we can pull from a catastrophe model, nor is it clear cut. We've already talked about severe thunderstorm. Flood, it varies. You have this rule of 1 degree C, 7% retention of water vapor in the air, but there's no guarantee that that water is going to come down in precipitation. It's just in the atmosphere. So most of the discipline is not only managing uncertainty, but communicating that to the client. So what are we doing at Verisk? We're constantly testing, constantly acquiring new data. We have interesting academic partnerships to make sure that in excess of our 120 PhDs on staff, we're not missing something from another university.
Very interesting. Awesome. So I think we'll conclude there. Thank you so much to the panelists. It was really interesting. Thanks, everyone, for having us.